And on today's show, how split interest charitable trusts can be significant for donors and charities, Session 2. Part 5 of this week's series on the end of the year charitable giving strategies for 2014 with top producers Mike Kilbourn, CLU CHFC, and Rob Odell, CFP. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Insmark, Life Specs, and Backroom Technician. Let's get down to business. Well, welcome Rob.
Do that.
Mike. Wow, we've been all over the map. I thought charitable giving was just give out of your cash account and call it a day. But this is really intense. Now, yesterday's show, you have to watch yesterday's show first. Otherwise, you will be completely lost. And I have to say, even I had to actually pay attention this time because this is really, there's some nuances in here that you have to pay attention to. The three types that we talked about yesterday were just really, really great ideas and great. What I would say is I love the idea to come up for clients that have avenues and approaches that they probably are not being shared. Nobody's sharing this stuff with them. And I like our advisors. We say we're always looking for things that are anomalous, that are unique, that'll cut us out of the pack, make our practice look differentiating. Mm-hmm. I think this is a big one.
Sure.
So let's do session 2 of split interest.
And this is going to be on the charitable lead annuity trust. The last program was on the charitable remainder trust. Now the charitable lead annuity trust is just like charitable remainder trust, but the opposite, meaning during your lifetime, income goes to charity, and then at the end of the term, it either goes to a trust, a beneficiary, or back to the grantor, depending on the type of the charitable lead annuity trust.
Walk me through why that would be something, the income is going to the charity, and my beneficiaries or other trusts later on after I die will then get the corpus of that.
Correct.
Why?
Well, the two big reasons. Number one, if it's a grantor trust, we'll get into that, it's income tax planning. They get a large upfront income tax deduction.
Right.
For a non-grantor, it's for gift and estate tax planning that we would look at. And often those are in testamentary form, but we'll focus on the non-grantor in the second part of this series.
Okay.
So let's talk about it. So you make a gift to a CLAT, it's irrevocable, money goes in there, you can't get it back, it's paid to charity, and at the end of the term, it comes back to the donor, to either the donor, trust, or beneficiaries.
Is there a minimum time on this?
No.
You actually calculate the time to get the best tax advantage, and we'll get into that.
So let's start. Let's talk about the grantor charitable lead annuity trust, also known as CLATs. And what makes the grantor CLAT unique is that when assets go in, typically it's cash going in. Unlike the charitable remainder trust, we had appreciated property. They get an immediate upfront income tax deduction. It's boom. It's based on the present value of the future income that goes to charity that they receive the deductions for. It's grantor. So once they get that income tax deduction, any investment activity in that trust during the term is taxed back to the grantor. Okay, and there's no deduction for the charitable annuity payment.
So the goal here is to get a person that has a huge payment that in 1 year that wants to have a large deduction to offset it, for example.
Correct. And the investment management becomes very, very important. And typically the type of investments that we see in these type of entities are tax efficient. So municipal bonds, life insurance cash value, low portfolio turnover. So you want to keep taxes down once they get that immediate upfront bump.
Right, because they're getting their deduction up front, but now every year that as the trust is making earnings and is going out to charity, somebody has to pay the tax on it. Well, it would be the grantor would be paying the tax as that happened. As the money goes to charity, they have to pay the tax. But if we put it in something like a muni bond, he would avoid that issue.
So really, tax advantage products are really at the high end of this idea.
Absolutely.
For a grantor.
So the candidates you look at is someone who's in high current taxable income now, a professional athlete, they're making lots of money now. In the future, they're probably going to be down a couple of brackets, right? Or corporate executives. Someone who might have exercised a boatload of non-qualified or qualified stock options that they have income, where they have spike years of income. Those are the candidates. So the example Mike and I are going to give you is a soon-to-be retired executive, Carl and Carol, mid-60s, committed to charitable giving. These people are very generous. They give $50,000, $60,000 a year to their church and other groups. They really do not have appreciated assets, and they have the last big year of income before they retire. So this is a candidate for this. So what this looks like, I'll run you through an economics here. Here you go. This is a grantor charitable lead trust. If they were to take $400,000 of cash, put it into a charitable lead annuity trust that pays 15% to charity for a term of 5 years. Okay, so pay $60,000 a year for 5 years. Their upfront income tax deduction will be just shy of $280,000. So what happens is cash comes in, payments for the next 5 years go here. They receive the upfront income tax deduction in a year that they could use it, and then at the end of the term of the CLAT, the money goes back, or the corpus goes back to Carl and Carol.
Right, so this is not an estate plan play here, not a gift. They're actually they're making a circle here. They're coming, the asset's going to go out and come back to them, but what they get right up front is that big deduction, and that's what they were looking for.
Okay, now I'm trying to make sure I understand the circle of life here, because really I've gotten a deduction for this, but you're saying I'm going to get my original money back?
Not the original, whatever is in this
whatever's
trust.
left.
Right.
Right, but think about it. The current 75/20 rate right now is 2.2%. Well, if this trust is earning 10%?
Anything above 2.2%, that comes out of their favor. So you don't need to take excessive risk here. So if they earn 5%, 6% on the earnings,
They should be happy.
They should be happy because of that low interest rate environment.
We come back from the break, we're going to continue. This is really exciting to get into new ground, even for the Savant, I must say. So when we come back from the break, we're going to continue in session 2. It's not how much money you make for your clients, it's how much money they get to keep, especially in retirement. But retirement income could cause Social Security benefits to be taxed. One tax advantage alternative is life insurance designed as a non-modified endowment contract that can generate tax-free income without taxing Social Security benefits. These contracts offer differing funding options depending upon your client's risk tolerance. For more information on how life insurance can be part of your retirement planning, just email me at steve@downtobusiness.tv. Brought to you by Ash Brokerage, the practice enhancement company. Well, welcome back to our second segment. Of course, we're with Rob and Mike. You're walking us through this. Now, we did the grantor clat. Now let's do the non-grantor clat and walk me through why that works in another scenario.
Well, first review, the grantor clat is for income tax planning,
Right.
primarily. The non-grantor clat is for estate and gift tax planning and has major implications there. So let's talk about the basics of what a non-grantor charitable deed annuity trust, some of the tax implications. Number one, unlike the grantor clat, there is no upfront income tax deduction. There's no income tax deduction at all. However, as investment activities occurring inside that clat, as it makes payments to the charity, they receive a deduction for the income paid out, that the clat it does. So there's no real positive income tax coming back, phantom tax coming back to the grantors. However, they get a gift and estate tax deduction. And this is why people who are fairly wealthy do these, is that they would rather have the income go to charity for a period of time and come back to their families. So there's a gift and estate tax for those individuals. We'll walk you through some.
So unlike the previous example, the asset's going to go out to charity and then feed the charity, so to speak, and then come back at a grantor trust. But in this case, it doesn't. It goes to the beneficiaries or a trust for their benefit.
So is that the significant difference between that and the grantor? So still the income's going to the charity, the remainder comes back, but instead of coming back to the grantor, now it's going to
the charity.
The charity.
Excuse me, to
or
the
the beneficiaries. Okay.
And one of the things you need to be careful of is generation skipping considerations here, because this is not a skipped trust. If this is not a skipping trust,
right.
So you need to be very careful how you set this up. Typically, the type of people that we see doing this, the candidates for a non-grantor clat, tend to be large estates, high net worth individuals, and who are giving to charity. And often, sometimes you do the economics on this, and you look at, you have a large estate tax bill, well, you can give it to a clat for a period of years. You could almost, not quite, but almost say what you're giving to IRS is now going to charity. And when high net worth individuals look at this saying, I'm going to pay X amount of dollars of taxes, but I can just direct those taxes to charity, I'll choose charity over the government.
Okay, so when you're looking at this difference, you're talking to a client. After you kind of do your due diligence, you're really trolling in the discovery process of what the intent or goal is here.
Correct.
Once you understand a goal, if it's really defined by the client, really this is just easy. This is an easy solution. I mean, I thought it was going to be harder, but it doesn't seem that hard.
Correct.
One of the best candidates for this would be somebody like a client I had who was giving $50,000 a year every year and planned to do it indefinitely going forward. Well, I said, well, why wouldn't we do a present value analysis on your gift of $50,000 to see how much we could put into the charitable lead trust that would eventually go to your family tax-free, completely tax-free of tax. So we did a present value, and it turned out to be somewhere between $500,000 and $1 million. I can't remember the number of monies that would go to the children without any tax. No, it doesn't have to use any gift tax exemption, just goes because they were smart enough to put it into that trust and continue making that $50,000 gift that they had planned to make in the past.
Now, so when I'm looking at that, though, Mike, I'm thinking, is there a threshold here of a client? Like you say, yeah, Steve, most clients have a net worth of about $3 million above. What's the real threshold of entry for
just
this?
Take a zero off on that last example. At 50,000, what about 5,000 a year? We can do this. Maybe it works back to a gift of.
But for the non-grantor, you're looking at someone who's subject to estate taxes or could be subject for estate taxes. So the non-grantor, why we like them is it gives you flexibility in the planning process. And one of the things we see frequently for high net worth individuals who have a taxable estate or projected to have a taxable estate is do this on a disclaimer basis, disclaimer planning basis, meaning they'll set this trust up, it won't be funded until death, and the executor or the trustee can determine if it's going to be funded at all. So let's say they get out to the second, mom and dad, second one passes away, it's a $50 million estate. The trustee and executor can sit and say, well, maybe we'll just take $20 million, put it into lead trust, get 100% estate tax deduction, so no estate taxes.
No, zero estate tax.
Pay the charity, and then it comes back to us in 20 years. So it's a deferred inheritance. So
right now, the kids may have a problem with that because they say in 20 years we'll be pretty old, mom and dad. Well, they might be, so it might go to the grandchildren. And again, there we have to be careful what we do because there might be a generation skipping tax.
But if I know that going in, and I can kind of do, as you always famously point out about forecasting, right? I have to do a little assumption in my future planning. I can keep that in the back of my mind. I have to watch the generation skipping tax. I don't want that.
Right.
But there's some ways to play with this. Now, again, the entry level, when I keep thinking like most of my advisors, they go, oh, if this person has an estate plan. So I automatically cut the line off at 10.3 million or whatever the unified credit is, or whatever the credits are now. Am I just making a mistake thinking like that, Mike?
Well, for the grantor trust, you want to be thinking estate taxes. So they're subject to estate tax.
But if I don't have that, am I hearing this correctly? The non-grantor
you wouldn't necessarily use this method. We might come up with a better method of.
But the barrier, I guess, my entry level as an advisor
is above the exemption level.
Okay, it's above the exemption
level. For the non-grantor. The grantor can be low.
Yeah, that part I got. All right, I just want to make sure, because there's rules of engagement here, and I'm just trying to think, am I hearing you correctly? Okay.
Right.
Okay, so we've given them several different ways in your term, and you're using this term under a canopy, split interest charitable trusts.
Correct.
So these all have applications. You've given us 3 types, and you've walked us through the mechanics of it. I'm trying to think, if I'm an advisor and I have a client my first time out, I don't know this. So are you available to be helpful to
absolutely.
That'd be great.
And I've got my book, Disinherit the IRS. Don't die till you read this book. And it's very easy to find because it's disinherittheirs.com.
Well, that's all the time we have for today. Remember, before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? Just go out to our video archives. And remember, you could be wiser as an educated advisor. I'm Steve Savant. We'll see you next week.